Hi, in this lesson we're going to get into and talk about involuntary liens and homestead exemptions. So in a previous lesson we got into the voluntary liens, the mortgages, trustees, and land contracts. Right now we're going to get into the involuntary liens, property taxes, government assessments, mechanics liens, HOA assessments, and judgments. We left IRS liens off because we talked about them in an earlier lesson. So let's first and foremost get into our bus here at the Hogan School and take a virtual field trip. All right, so we're going to go downtown Tucson. Now we live and we're situated here in Tucson, but I would strongly suggest that no matter where you live, that you go to your downtown and find the treasurer's office and the assessor's office and the recorder's office and get to know those places. Here I am on Wikipedia with a list of the counties in Arizona. You can see them on the map to the right. And if we scroll down, what you'll find is a list of all of the different counties and the cities in which the county seat, the treasurer's office, the assessor's office, and the recorder's office happen to be. So here's this list for you right here, and you can check it out on your own in more detail on Wikipedia. So here we are in Pima County at the new Public Service Building at 240 North Stone. Now this is a brand new building basically. I like the old courthouse myself a lot better. This beautiful old building that is being renovated. And years ago I actually went down to and took a trip, took a few photos. Here's the treasurer's office and the assessor's office, and also visited the county recorder. And in visiting the recorder, who at that time and still today, as I'm recording this, is Ann Rodriguez. She gave us a little bit of a tour, and we looked at some of the books, the recorder's books and records from way, way, way back when. You know, years ago they didn't do anything digitally. They didn't even have photocopiers. So what they actually did was they made multiple copies of deeds and multiple copies of mortgages. They did copy A, copy B, copy C. So they actually had people write these things out. And they would deliver those to the recorder. And in the book, the county recorder's books, they would actually include a copy of this. And you can see this one here dates back way into the 1800s. So recording has become much more sophisticated today. As we've talked about in a previous lesson, recording typically is done here throughout Arizona using a sequence number. It used to be a docket and page number, but now it's typically a sequence number. Just every new document that's recorded gets the next highest number. Well, why are we talking about this? Well, because as far as lien priority is concerned, I think we've already discussed the fact that taxes always have number one priority and other liens fall generally in the order in which they're recorded. But taxes, and it's pretty important to understand this, taxes always have number one priority. Why? Well, very simple. The government wants to make sure they are in top position. They are in first position. So no matter what lien we have, property taxes are always number one. We have what is called, another Latin term for you here, an ad valorem tax. Ad valorem simply means based on or according to value. So as values of properties increase, the taxes are likely to increase. As values decrease, the taxes are likely to decrease. But it's not just that simple. Not just that simple. Because we have in Arizona what's called an affidavit of value, which informs the assessor as to what's happening to values around the county. Now the county assessor is an elected official, and his or her job is to actually evaluate properties for tax purposes. And this affidavit of value, you might recall from a previous lesson, is required in order to record a deed. So when you present a deed on a property that you've purchased, or when the escrow company presents that deed, it has to be accompanied by an affidavit of value. The buyer and seller sign this document, and it states the sales price. That information then is public record and gets passed along to the county assessor. And with that information, the county assessor uses that along with other sales in the same area or similar areas to place a value on the property for tax purposes. And the value that the county assessor actually calculates or estimates is what's called the full cash value. And here I have a screenshot of the full cash and what's called the limited property value, and we're going to define these both in a minute, on a property here. This is where our office is on Grant Road in Tucson. Now this screenshot is actually an older screenshot because currently the county assessor has changed the look of their website here in Pima County. But I still keep this old one here because of the fact it's a lot easier to read. So what you have down at the bottom portion of this is you'll notice it indicates a full cash value, also a limited value, and then an assessed value. And we're going to go into and talk about those things right now. So first and foremost, what is the full cash value? And this is true around the state. I'm not just talking about Pima County. This is state law. Full cash value is the value placed on the property by the county assessor. They do this once a year. They do it actually at the beginning of 2018. They send you the full cash value for the year 2019. So they're always looking at this a year in advance. So the full cash value is determined by the assessor annually. You may appeal it. This is the value that you would appeal. You cannot appeal your taxes, or rarely can you appeal your taxes unless there's an egregious error. But what a tax appeal is all about is appealing the full cash value. And you can appeal that within 60 days. You get a notice of full cash value in the mail, and you can appeal it typically within 60 days of receiving the notice of full cash value. Next is limited property value. Now the limited property value is the value upon which the property taxes are based. Now this may seem a little bit strange, but the limited property value is related to the full cash value, but it is limited as to how much it can increase. So by law, the limited property value may not exceed the full cash value. Can't exceed it, can't be higher than the full cash value. Can be lower, oftentimes is, but it can't be higher. And the maximum increase in the full cash value 1 year to the next, the maximum increase in the limited property value from 1 year to the next is 5%. So even if the full cash value increased by 10% year to year, the limited property value would not be able to increase more than 5% that year. And the next year, no more than 5% above last year's limited property value. So when we have an appreciating market year to year to year, the limited property value is limited as to how much it may increase. So here's an example. Let's say in 2017, the full cash value and the limited property value were the same, $100,000. But in 2018, the full cash value was estimated by the assessor to be $110,000. Because of the limitation on the increase in limited value, the maximum limited value would be $105,000. That's that 5% maximum increase. Let's say that instead of going up to $110,000, in 2018 the full cash value went down from $100,000 to $93,000. In that circumstance, the limited property value would have to be $93,000 or less. Chances are the assessor would not make it less than $93,000, but would have it at $93,000. Why? Because it cannot exceed the full cash value. What's the bottom line? The limited property value cannot increase more than 5% per year, but cannot exceed the full cash value. So if the full cash value declines, the limited property value is going to have to decline as well. You need to understand the math formula for calculating taxes. And it's a two-step process. First and foremost, we take the limited property value as determined by the county assessor. We multiply that by what is called the assessed value ratio, or sometimes referred to as the assessment rate. And that gives us what's called the assessed value. When you receive your notice of full cash and limited and assessed value in January or February of each year. It lists the values for the limited property value and for the assessed value. And it's based on these ratios, which I'll explain in just a minute. We then take the assessed value and multiply it by the tax rate. But the tax rate is not determined until much later in the year. But whenever it's determined by the county or the city, we then wind up with the annual real property taxes. So you should write this formula down. You should memorize it because you're going to get some questions on property taxes, and this is the formula that would be followed. So let's talk about these assessed value ratios or assessment rates. First of all, by state law, if it is an owner-occupied residential property, the assessment rate is 10%. If it happens to be an investment residential property, an apartment building, for example, it's still 10%. So whether it is owner-occupied residential or it is rental property residential, it's 10%. 15% is the assessment ratio for vacant land, and 18% is the assessed value ratio for commercial property. So vacant land is assessed at a higher rate than residential property. The idea behind this, in theory, is that the higher assessed value ratio, creating higher amounts of taxes, would induce owners to develop that. The 18% on commercial property used to be actually as high as 25%, but it's been reduced over the years to 18%. That 18% assessment ratio is thought to, again, place a greater portion of the tax burden on commercial and investment properties rather than residential properties. So those are the assessed value ratios for the three major types of properties that we're concerned with. Now, the tax rate. The tax rate is actually calculated by the city or the county in which you live based on a whole bunch of different issues like schools and libraries and police and fire and a whole bunch of other things that go into determining the tax rate. And the tax rate is either quoted as so many dollars per $100 of assessed value or so many mills. Now in Arizona we don't use millage. A mill, however, is 1/1000th of a dollar or 1/10th of a cent. And on the national portion of your exam we have seen questions dealing with mills or millage. You'll have some examples in some of the math questions that you'll see. But this tax rate is set by local government, and here in Arizona, it's always stated as so many dollars per $100 of assessed value. So here's an example. Let's say we have an owner-occupied residence with a tax rate of $18 per $100 of assessed value. Remember the formula. We take the limited property value, $100,000 in our example. We multiply that by the assessed value ratio, 10%. Why? It says it's a residential property, and that gives us our assessed value of $10,000. We then multiply that by the tax rate given in the problem, which is 18%, and that gives us our property taxes of $1,800. If this was a commercial property, instead of being an assessed value of $10,000, and since the assessed value ratio would be 18%, the assessed value would then be $18,000. If this was a piece of vacant land worth $100,000 limited property value, then the assessed value ratio would be 15% and the assessed value would be $15,000. Now, the treasurer is the person responsible for collecting taxes. And the tax is levied by state law annually. So keep in mind, January 1 is the lien date for taxes. So remember, when you're sipping your bubbly on New Year's Eve as the ball is dropping, I don't want to put any throw any rain or drops on your. I don't want to be a party pooper, but please realize that at New Year's Day, the taxes become a lien on your property for the coming year, in advance for the coming year. Taxes are levied also on a calendar year basis. The tax payments, however, are typically made semi-annually, and they're on a fiscal year. Now, the fiscal year, the monetary year, begins July 1st and goes through June 30th. So for 2018, we're here at the beginning of 2018, The 2018 taxes began January 1st, but we don't know what they're going to be because the fiscal year 2018 doesn't end until June 30th of 2018. And they don't figure out what the tax rate is going to be, and therefore they don't figure out the taxes until actually the end of the summer, typically late August or early September. And when you get your tax bill, it comes in two pieces, two coupons. You can pay the whole thing if you want, but typically most people pay only the first half when required and the second half at a later date. So how are taxes paid? Well, the first half, let's assume it's $900. It doesn't matter how much it is. The first half doesn't become due and payable until October 1st. The tax bills don't come out typically until September. And the more important date really is the delinquent date. Taxes for the first half of the year become delinquent November 1st of that year. The second half of the year, July 1st through December of the year, of any year, does not become due and payable until March 1st of the following year and becomes delinquent, and that's really the key date to remember, delinquent May 1st of the following year. So how do we remember these dates? Well, the key is another acronym or a little, I don't know what they call it, a homonym, an acronym, a little saying. The saying is O, no, more, money. O for October, that's the due date for the first half. N for November, the delinquent date for the first half. M for March, the due date for the second half. M for May, the delinquent date for the second half. Some of you might be asking, why only 1 month from October to November and why 2 months, March to May? Well, actually, the law used to say the due date for the first half was September. But the counties had trouble getting their budgets together and getting their tax bills out by September 1st or so, or before September 1st, so they changed the law to the due date being October 1st. What happens if taxes become delinquent? Well, if taxes become delinquent, the treasurer is required by law to conduct an auction and sell the tax lien. First of all, interest begins to accrue on delinquent taxes at the rate, this is state law, of 16%. So what happens November 1st? You haven't paid your first half of your taxes. Interest starts to accrue on that first half at the rate of 16%. What happens if May 1st comes around and you haven't paid the taxes for the second half of any year? Interest begins to accrue on the second half at the rate of 16%. Pretty expensive, but that's the statutory rate for delinquent taxes. Let's talk about the treasurer's sale or the tax lien auction. So if someone doesn't pay their taxes, eventually, and always in February of every year, the treasurer will hold an auction where that lien, the treasurer's lien, will be sold to the highest bidder. Now the property is not being sold, it's the tax lien that is being sold. And the high bidder is not determined by who will pay the most money, because if the treasurer is owed, let's say, $1,000, the treasurer cannot accept more than the $1,000. So the high bidder is determined by who will bid down the interest rate to the lowest amount that the bidder would accept when the owner redeems that tax lien certificate. You'll see what I mean in just a couple of minutes. So, at the tax lien auction, the high bidder, the one who bids the lowest interest rate, is issued what's called a CP, a certificate of purchase to the bidder. So let's say that $1,000 is owed and I bid at the tax lien. I will start my bidding, I'll say 16%, which is the highest interest rate that I can bid. But let's say that other bidders are interested in owning that tax lien. So you might bid 15%, and then I bid 14, and a third party bids 12. The bidding will go down in no greater than, or no less than, I should say, 1% whole number increments. You can't bid 14.371. So let's say that you wind up being the successful bidder and you bid 7%. So the treasurer then will assign their lien to you for the $1,000. You pay the treasurer the $1,000, so the treasurer's got her money. And at that point, you hold a certificate which says you're entitled to get your $1,000 back plus 7% interest when and if the owner redeems. And by the way, in about 99% of these situations, the owners do redeem. So can you acquire properties for pennies on the dollar by bidding on taxes? Yes, but it's actually quite rare that the property is transferred as a total percentage of all of the tax liens that are sold. Now, once the tax lien is sold, again, the owner still owns the property. The bidder simply has a lien, a certificate on the property. Then you begin what's called a 3-year redemption period from the date of the sale, during which time the owner can come in and redeem, and they do this through by paying the taxes to the treasurer, and if you're the successful bidder with the certificate, you get a check in the mail. So the owner will pay that amount bid, the $1,000 in our example, plus the interest, that's 7% on the certificate. Now some of you are probably saying to yourself, well, gee whiz, does the county still charge 16? You get 7 and the county gets 9. The answer is no. The county has sold their lien to you. So the benefit of you bidding down the interest rate actually goes to the owner, who instead of now paying 16 is only paying 7. Proceeds from the redemption, once the owner comes in and redeems, are paid to the certificate holder, so you get a check in the mail. If there's no redemption, what if the owner does not redeem during that 3 years? Then you can begin a foreclosure and get a treasurer's deed. In other words, begin a foreclosure, and this is a court action, and we're not going to go into and talk about the foreclosure process here, but you go through a court foreclosure, a judicial type foreclosure. It doesn't come up for a public auction, and if the judge finds that the bidder owes the taxes and you're entitled to the property, they will order the treasurer to deliver a treasurer's deed to you, which delivers ownership. You don't have to begin a foreclosure after the 3 years. You can let the interest continue to accrue on the certificate in hopes that the owner will come in at some point and redeem. However, you must begin a foreclosure action within 10 years from the date of the auction, or else the lien becomes void. So here's an example of a 2017, what I call a tax lien timeline. You have this in your course material. So let's say in November of 2017, the first half for 2017 became delinquent. The second half became delinquent in May 1st of 2018. So it wouldn't be until February of 2019 that the tax lien auction would be held. And let's say you bid on that property and get the certificate for the 2017 taxes, and you bid 7%. Now we begin a 3-year redemption period, during which time the owner can come in and redeem by paying the taxes plus all the interest owed on your certificate. You get a check and they're redeemed. However, if they do not redeem, after 2022, after February of 2022, you could then begin your foreclosure to try to acquire the property. So that's it on a tax lien timeline, on a tax lien foreclosure. That's it on the tax lien foreclosure process. If you're interested in more information about this, check with your county treasurer and look on their website. We also offer different classes on how to invest in tax liens as continuing education credit, so you might look for those in the future. In an earlier portion of this course, we talked about the Affidavit of a Fixture. I just want to remind you that what the Affidavit of a Fixture does here in Arizona is that it makes a mobile home real property. And it is now considered to be taxed as real estate. So this Affidavit of Fixture, not dealing with how the property is physically affixed to the property, but it's a legal document through which they turn in the titles to the manufactured home, which at that time was personal property, and recording this Affidavit of a Fixture makes this manufactured home real property. The next involuntary lien we want to talk about is assessments, or government assessments. And all we really want to say is that these have number 2 priority. So sometimes neighborhoods petition the government to install street lights or sewers or some other municipal facilities. What the government does often here is they will create what's called an improvement district, and they will sell bonds. They will basically borrow the money by selling bonds, raise that money to be able to construct the improvements. And what they'll then do is they'll place an assessment lien against all of the owner's properties, all of the owners who benefit from this assessment. So assessments are commonly levied on a front foot basis. Years ago, our property along Grant Road here had assessments levied against it for street lights. And the amount of front footage that we had along the main street dictated what our assessment was going to be. In residential properties, residential areas, typically we don't see assessments levied on a front foot basis, but they're typically evenly divided among the property owners in that particular neighborhood. So that's number 2 priority, special assessments. The next lien we want to talk about is mechanics liens. Mechanics liens, or contractors' liens, are liens placed against the property by a licensed contractor or a material supplier for work or material supplied to the property when the owner doesn't pay. So it is a lien for either labor or for materials. When it's a mechanics lien, what's called a preliminary lien notice is required. What does that mean? Well, by law in Arizona, the contractor or material supplier has to notify the property owner within 20 days of the work beginning. Oftentimes they do it before the work begins, but no later than 20 days after the work has begun, that they do have a lien right in the property if the owner fails to pay them. The mechanics liens have to be recorded, and if it's for labor, only licensed contractors may record mechanics liens. Okay? So the lien must be recorded, and it's only for licensed contractors where labor is concerned. Now, here's a called a redneck swimming pool. All right, this would not be eligible for a mechanics lien. Why? Because it's not on real property. I don't know what kind of lien you'd call that, but when we talk about swimming pools, that's not my favorite type of pool. Let's do something else with a swimming pool. Let's take a look at a mechanics lien timeline. So let's say that on January 1, the work on the property begins, and let's say you're having a pool put into your home. Well, and let's assume the contractor gives you this 20-day preliminary lien notice. The work ends, let's say, February 1st. Now, I know you're not going to get much of a swimming pool built in a month, but this contractor is so good that they just can't help getting the work done in an efficient way, and on February 1st, the work stops. And there's your nice swimming pool. Whoops, it looks like some vehicle rode into the pool there. In any case, that's your nice new pool. And because of maybe some problems or dispute, whatever, with the contractor, you decide not to pay the final payment. Well, the contractor then is going to send you bills, going to start maybe calling you and so on, send you letters. But if you don't pay the contractor within 120 days of the work stopping, that contractor must record a lien in order for the lien to be valid. So any time within that 120 days, the contractor may record the lien, but they have a maximum of 120 days to do it. So let's say they wait until the very last minute, but they record that mechanics lien. Now what happens? Be careful here. Right? The lien priority. The lien priority is not established as of the date that it was recorded, but because the contractor started his or her work on January 1, the lien takes priority as of January 1. So if you had put a mortgage on the property on January 5th, let's assume the mortgage company didn't know you were having this work done, and they loaned you the money and you gave them a mortgage on January 5th, the mechanics lien, once recorded, would actually have higher priority than the mortgage lien. That's a problem for the mortgage company. Well, we're not going to worry about that right now, but just keep in mind that the priority of a mechanics lien begins or takes place the day the work began. So the contractor recorded her lien here on June 1st, and now if you don't pay the contractor has 180 days within which to begin the foreclosure. So they've recorded the lien, they're still waiting to get paid, the owner doesn't pay them, but the contractor is going to have to begin their lien within 180 days of recording, 180 days of recording. If they don't, then they lose their lien right on the property. So let's recap. The contractor has to send this 20-day preliminary lien notice. The contractor work ends. They have 120 days from the completion of the work to record their lien. Once their lien is recorded, it jumps backwards in time and its priority is established as of the day the work began. From the date the lien is recorded, the contractor has 180 days in which to begin the foreclosure. If they fail to begin the foreclosure in that 180 days, they lose their lien right. That's a mechanics lien. Some of you might remember an old TV show where Tool Time Al was involved. One of the questions that we want to ask here is, does the standard owner's policy insure against unrecorded mechanics liens? The answer is no. But an owner can get an extended coverage policy which will cover against mechanics liens that have not yet been recorded, but for work that started at a previous time. Last point to make in mechanics liens: what if a tenant orders some work done and the tenant did not have the permission of the landlord to get that work done? In that case, if the contractor goes ahead and does the work without checking with the owner of the property and the tenant does not pay the contractor's lien right is only against the leasehold interest, not against the ownership interest in the property. So a smart contractor will always check to see if the owner has agreed, first of all, if the property is rented, and if it is rented, to see if the owner will agree to order the mechanics lien. Another type of assessment is a homeowners association assessment, an HOA assessment, which can actually come into or become an HOA lien on the property. So HOA assessments and HOA assessment liens have no special priority. They are subordinate. They're subordinate even to mortgages. So even though an HOA assessment has been levied and maybe not paid, if a mortgage is placed on the property after that, the mortgage lien has priority. Now, we're not going to get into the foreclosure aspects of an HOA lien, but they are foreclosed in court. So the HOA can take the owner to court for failure to pay their HOA assessments. They place a lien on the property and they can foreclose that lien and actually acquire the property through a court proceeding. The last lien we want to talk about here is a judgment lien. A judgment is a decision of the court against an individual. So you were maybe in a partnership with somebody and you had a dispute and your partner sued you and you lost. Or you were in an accident and didn't have enough insurance and the other party sued you and you lost. For whatever the reason, the court finds that you're at fault and they levy a judgment against you. Now, that creditor is called the judgment creditor, and he or she can collect by what's called execution. Execution can occur by garnishing wages, garnishing bank accounts, right? They can sell personal property, or they can foreclose against real or personal property. Again, we're not going to go into the foreclosure process here, but please realize that judgments are general liens. They attach to the individual and therefore all of that individual's assets. The recording of the judgment sets its lien priority. So keep that in mind. Judgments simply fall in the order in which they're recorded. And judgments have to be renewed every 5 years. So if a judgment is levied and they don't execute the judgment, don't foreclose the judgment or terminate it, that after 5 years they will have to renew that judgment. Judgments bear interest at what's known as the legal rate. You might remember from a previous lesson that the legal rate of interest is the rate of interest that would be charged if there's no agreement as to what the interest rate is, or oftentimes the court, when they levy a judgment, say that it will bear interest at the legal rate. It's not a specific number because it's tied to the prime rate, so you don't have to know what the actual number is because it will vary from time to time. Another question is, how are judgments revealed? How would you determine if there are judgments against someone or against their property? Well, through a title report typically is how a real estate agent would know, or through search of the county records, or through a credit report. Oftentimes credit reports reveal that an owner has a judgment against him or her. The last thing we want to talk about in this lesson is called the Homestead Exemption. And a Homestead Exemption is an exemption for a homeowner which prevents a judgment creditor from taking that person's home. So the idea here is to allow a judgment debtor to keep a roof over his or her head as opposed to the judgment creditor forcing the sale of the property. And the rules for homestead exemptions in Arizona: first of all, it's only someone's primary residence. So it can't be properties that they own for investment purposes. It has to be their primary residence. If they own 2 houses in the state, one in the mountains, one in the desert, then if they needed to use the homestead exemption, they would then designate the one that they wanted to be considered to be their primary residence and benefit from the homestead exemption. And homestead exemptions are used almost always when a bankruptcy is occurring. So it's rare that it would be used in any other circumstance other than a bankruptcy. So that person would typically have an attorney available to help them and to help them understand what a homestead exemption was all about. And it only protects against judgment liens. Please realize that if you voluntarily place a mortgage or a deed of trust on your property, that the homestead exemption is not going to protect you. That it's not going to protect you against a foreclosure for non-payment of property taxes or assessments. What it protects you against is foreclosure because of a judgment. The maximum exemption, remember it's called a homestead exemption, is $150,000. So basically what it says is it protects your equity or homeowner's equity up to $150,000. And the protection is automatic, meaning that you don't have to file or record any document. Years ago you had to actually record a document. Today it's automatic on your personal residence. So let's take an example here. Let's say you had a home valued at $200,000 and you had a first mortgage on your property of $120,000. And you're able to make your mortgage payments, you still have your job and so on. So you have an $80,000 equity in the property, but a $75,000 judgment is levied against you because you were in a car accident or you had some medical bills and you didn't pay those medical bills and the hospital went ahead and got a judgment against you. In that circumstance, because your equity is less than $150,000, the judgment creditor would not actually be able to foreclose. If your equity was a lot larger, let's say the property was worth $300,000 or $400,000, and you had over $150,000 in equity, they would be able to foreclose, but you would stand in line, the homeowner would stand in line for the first $150,000 of equity from the sale of the property. The judgment creditor can't force the sale if the equity is below $150,000. If it's above $150,000, they could force the sale, but you would stand in line for the first $150,000 of equity garnered from the sale, the foreclosure sale of that property. So that's our discussion on involuntary liens and homestead exemptions.